Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
On today's Bloomberg Intelligence Show, we dig inside the big business stories impacting Wall Street and the global markets.
Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide.
Today, we'll discuss why UPS suffered its worst stock decline in 25 years.
Plus, we break down Astrazeneca's quarterly earnings in a conversation with its chief financial officer.
But first, we dive into politics and the aftermath of President Joe Biden dropping out of the presidential race.
Many people are now wondering whether Vice President Kamala Harris could defeat Republican nominee and former President Donald Trump in November.
And this week, Bloomberg Intelligence took a deep dive into how a potential Harris presidency could impact different sectors and policies in the U.S.
For more, we are joined by Nathan Dean, Bloomberg Intelligence Senior Policy Analyst. And we first asked Nathan what life would look like if Kamala Harris were to win in November.
It's a lot of status quo for banks, EVs, big tech, and so forth like that. The one caveat is on taxes. And Kamala Harris's record in her tax, aspect of it has been a little bit more, I'd say progressive than what President Biden has said. But ultimately, we viewed President Biden as moving more towards Kamala Harris's policies when he became president, rather than Kamala Harris moving towards Biden's policies. So a lot of this, if she becomes president, will be status quo.
Oh, that's really interesting. So I was going to ask, where is Vice President Harris farther left than President Biden? Where is that biggest daylight?
So the one thing that we actually hung down on was her record as Attorney General. And, just indicative of one of her actions is she joined about 47 other states, including the District of Columbia, on a $25 billion settlement on home foreclosure practices. And a lot of her campaign speeches when she was running for president in 2020 was talking about how she took on big banks. Now, to us, that means there's a lot more consumer protection coming in the cards, whether it's the Consumer Financial Protection Bureau or whether it comes through acts of Congress, or maybe it's even executive orders like continuing President Biden's student debt relief plan. But I think there's going to be a lot of focus on this idea of low to middle income consumers, protections against big corporations, and a lot more in terms of disclosures and so forth like that. Now, is this a material impact on big tech or on the big banks? Probably not. A lot of it has to get passed through Congress, but ultimately it's certainly a headline risk that I would keep in mind for those sectors is just to keep in mind, that if she were to focus on this, and specifically, let's just pick on antitrust. If she were to focus on antitrust, there's a lot of, intense scrutiny, more scrutiny than she could put there than a Biden administration could.
All right. A lot of my M&A banker buddies are wondering what would a Harris administration mean for antitrust, because Biden's been nobody to the M&A world. Is it feeling status quo there as well?
This is one of those situations where I think whoever wins as president is probably not going to be helpful to your M&A banker buddies, because on one hand, you have the continuation of the Biden presidency with Lina Khan at the FTC and taking a very skeptical look at mergers. I mean, just in the financial space alone, some of these merger reviews go over a year, if not longer. And, we saw certainly with the TD Financial merger, they pulled out as a result of this. But then on the flip side, you have Senator Vance and President Trump. And remember, this idea of economic populism is ramped through that, that RNC agenda at the moment. So, Senator Vance even came down to a Bloomberg event here in Washington and called Lina Khan, the FTC chairwoman, Biden's best pick, and insinuated that President Trump should even keep her around. Now, I don't think that's going to happen. But unfortunately, Paul, for your M&A banker buddies, I don't think any other way this gets around, whether it's Harris or Trump, it's going to be a very skeptical world for antitrust and M&A.
So Paul's talking to his M&A buddies. I'm thinking about my energy buddies, because one area where it feels like President Harris could be farther left, of course, is energy. I was telling Paul earlier that she's been kind of anti-fracking, she's been anti-offshore. California is notoriously not loving any fossil fuels. How much of that do you think we have to really start considering?
I think it's important to consider it. In fact, our colleague Rob Barnett put out a note talking about this and the importance it has on the renewables sector. So Vice President Harris, certainly has pursued a clean energy agenda. And one of the things we see in, her presidency as a boosting of the Inflation Reduction Act. I don't want to say going back to the Build Back Better 3.0, some of the ideas that were floated around. She'll have her own ideas here, but this idea of the Inflation Reduction Act needs to be protected and enhanced. So if you're in the renewable sector or solar sector, it certainly could be a boon idea if Vice President Harris wins. I would also just offer this, that a lot of it also depends on who takes up Congress, because if Vice President Harris wins and the Republicans take one, if not two, chambers of the House, then a lot of those initiatives are going to be scaled down and actually dramatically lowered and so forth like that.
All right. We know Elon Musk is a big supporter of Trump, but what would a Democratic Harris administration mean for the Elon Musks of the world and the EVs?
So, for the EV side, I think it's actually a continuation of the Inflation Reduction Act tax credit, if not an enhancement of that. Look, tax reform is going to happen next year no matter what, because the Trump-era tax cuts for individuals expires at the tail end of 2025. And whether it's Vice President Harris or President Trump, neither of them are going to want to increase taxes for low and middle and income, Americans. So for the EVs of the world, I would say under a Harris presidency, you'll certainly have protection from that tax credit in the IRA. You potentially could have an enhancement of that. You certainly will have regulatory policies trying to boost EV usage and so forth like that. Comparing it against the President Trump presidency, where he has said that he doesn't like electric vehicles. Obviously, he has Elon Musk whispering in his ear and providing $45 million a month in PAC funding. But ultimately, I think the Republicans, you probably would see a scaling back of those tax credits. Maybe, just additional, restrictions on EVs and so forth like that. But, with the Trump presidency, we'll have to see if he wins and also if Elon Musk is whispering in his ear in come January and February.
Taxes. If former President Trump were to get a second term, is there any consensus in Washington, given the makeup of Congress? And I guess we have to see how Congress shakes out. But what, if anything, could the Trump administration get done on taxes?
Yeah, so, the way I think about the tax debate with my colleague Andrew Silverman is really in terms of timing. So the first thing you'll note is the election. If the Republicans take the House and the Senate and the presidency, then they have this opportunity for reconciliation. This is how they got the Trump-era tax cuts through in 2017. It allows them to actually move forth and enhance or, essentially conduct tax reform, and they can bypass the Democrats. So if the Republicans win the House, the Senate, and the presidency, then this President Trump's idea of lowering corporate tax rates is certainly in the cards. Now, I have seen statements from House Republicans saying, maybe we don't want to do that so much, but I do think that this would be President Trump driving this. Now, if you get more of a gridlock Congress, well, then the power of Congress is going to come out, and the House and Ways and Means Committee, whoever controls it, is certainly going to want to play here and tell the presidency this is what we think. And so if you get a gridlock Congress, a lot of the tax reform or tax relief ideas that are out there are going to be scaled down and narrowed, but with one objective: not to increase the individual tax relief or tax cuts for that individual. If you get President Harris, you may see tax increases for individuals who make greater than $400,000, but I think most individuals in the United States at the end of 2025 probably won't have their taxes altered all that much.
Our thanks to Nathan Dean, Bloomberg Intelligence Senior Policy Analyst.
We move now to corporate earnings and begin with the EV giant Tesla. Tesla reporting another quarter of disappointing profit and postponed a highly anticipated unveiling of autonomous taxis.
For more on all this, we were joined by Steve Mann, Bloomberg Intelligence Global Autos and Industrials Research Analyst.
We first asked Steve for his key takeaways from Tesla's results.
I still like their long-term, medium-term outlook on AI. In our view, we're not including 8 billion Optimus robots. I think that's a little bit out there. But AI will continue to drive the stock. But I think people are focused on their auto business. It's a little bit worrying. I think investors were expecting their automotive gross margin to flatten out in the second quarter versus the first, but it did decline about 150 basis points to 13.9%, which is in line with the legacy automakers' automotive gross margin of 14%. So there is some concerns with the investors. Are there any more upside on margin? Are they really that good with cost?
But I guess the question is, how do we value the stock? So I hear you that the auto part of their business is very much maybe in line with what other auto companies are talking about, but they trade an estimated PE of like 90 times. Like, is it worth it for that if it's also being valued as an AI company?
I think there's a couple of things that the investors are focused on beyond the second quarter. They did pull ahead the start of production for a more affordable EV. From like the second half of next year to the first half, which is critical. I think the EV market today globally is actually consumers in the EV market are actually looking for a more affordable EV, something that's less than $50,000 US. Most of the EVs offered today are above $50,000. So I think investors are hoping that into 2025 and into 2026 we're going to get a rebound in EV sales because there's going to be more affordable EVs, budget-friendly EVs for the mass market.
Steve, Tesla right now is an auto company and it's an other company. Elon wants you to focus on the other. Can you define what's in that other bucket and when investors believe it will be material to their revenues and profits?
Yeah, he talks about AI quite a bit, robo-taxi, the Optimus robot. But if you think of AI, I think there's, potentially even more ways to generate revenues from AI. One of the things that I think the market is also focused on, other than robo-taxi, taking a passenger from point A to point B, is, for example, these cars have huge battery storage capacity. Right, and these things, if they can move about on its own, you can really help out the utilities in terms of, redistributing power across the grid.
Well, to that point, I mean, their energy business was actually quite impressive. It had its highest installation of batteries and revenue ever, and energy accounted for just 12% and 16% of Tesla's revenue and gross profit, respectively. I mean, it's going to fluctuate, but that's pretty strong.
Yeah, it's a good sign. I think those tend to be a little bit lumpy because the orders are big. And so whenever they deliver the order and whenever they book it, that tends to be lumpy. I think we'll have to see if it's going to be consistent. But I think the investors are very focused on the auto business. Are they going to be on time in rolling out the new EV, the affordable EV? And then longer term, it's really, AI. Is he going to deliver? What is he going to say in October, the AI event that he's hosting? There were a lot of questions about that during the call, but they were pretty tight-lipped.
Our thanks to Steve Mann, Bloomberg Intelligence Global Autos and Industrials Research Analyst.
Coming up, we're going to break down how demand for cloud computing services and advertising impacted Alphabet's quarterly earnings.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Alex Steele, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
We move next to earnings from logistic company UPS.
This week, UPS suffered its worst stock decline in 25 years after reporting profit that missed analyst estimates for the quarter.
The company also trimmed its forecast for the year, and this comes as UPS has failed to deliver fast enough on a turnaround plan to cut costs and increase volumes.
For more on this, we're joined by Lee Klaskow, Bloomberg Intelligence Senior Transport, Logistics, and Shipping Analyst.
We first asked Lee why it was another tough quarter for UPS.
I think it's a lot of things. They are seeing volume growth, which is good, but that mix of growth is not good. What they're seeing is their shippers trading down. So if you were going to maybe send something via air, maybe you decide to go on the ground, which is cheaper and lower margin. And then if you're using ground, maybe you're going to use one of their products like SurePost, which is like an economy product, which is cheaper and again lower margin business. So you're also seeing the mix of B2C outpacing growth of B2B. B2C growth was around 4% and B2B growth was down 4%. And B2B, so think like a lawyer sending documents to another lawyer's office, that business tends to have better margins because of the inherent density that follows that business. And density is really good for asset-intensive networks like UPS's. And then you also, have another negative mixed impact. You had two, they called out on their call, two large e-commerce companies. I'm assuming that, these are companies out of China that are, are kind of using more economy services. So you're seeing a surge in that demand from there as well.
Is this the trough? Is this sort of the worst it's going to get?
It's a great question. I mean, I think so. I think it feels like this is the worst. I mean, the company has done pretty well in terms of meeting expectations or beating expectations. This is the first miss since I believe the first quarter of 2020. So, Carol Tomei and her team have been on quite a roll. They also have some easier comparisons going into the second half. Some of your listeners might have remembered they had a new contract that was really, heavily weighted in the first year. That gets anniversaried in August 1st. So therefore, those higher labor costs, the comparables will ease significantly, after August 1st. So that should provide a better cost for them in the third quarter and going forward. Also, peak season's here, right? A lot of the companies that we cover are talking about most of them are expecting a real peak season. And we're not talking about, the peak seasons that we've seen in the 1990s or early 2000s, but you're definitely going to see seasonal increase in demand. And that peak season is one of the shortest on record. It's around 17 days between Thanksgiving and Christmas, and that will allow UPS to implement surcharges because they're going to have to, get those resources in a short amount of time for a short amount of time to make sure that they're able to deliver at high service levels. So you should see probably some good revenue growth in the fourth quarter from those surcharges. So that coupled with a lot of their cost cutting measurements, they've reduced a lot of heads. I think a lot of things are going to turn for this company once you're going to see that B2B volume return. And the company is doing a lot of things, I think, to position itself longer term, whether that's, focusing on the healthcare logistics. Healthcare logistics, obviously, there's a lot of value add there, and those margins are pretty high relative to, someone throwing a package on your porch. And so, they're really looking to grow that business, and they want to be a leader in that business. And to be frank, it's a fantastic business to be in if you're a logistics provider. And then, they're also trying to do new things with, or more things, I should say, with what we call SMBs, which are small, medium-sized businesses. That tends to have better margins than, dealing with these super large companies like Amazon, which, the business is good, but the margins could be better.
I have actually no loyalty between these two services. I mean, the FedEx store and the UPS store are kind of right next to each other in my little strip mall. So whichever's got the shorter line, that's kind of where I go. But from an investor perspective, you got 30 seconds here. What's the difference between these two companies from an investor perspective?
Well, it's interesting. So like on FedEx, I think they're dealing with more structural issues because that was a company that I would say was extremely bloated, over the last decade, and they're kind of right sizing their network. They're both making changes to their networks to kind of meet the new demands, that change of increase in home delivery versus, delivering to lawyers or doctors' offices or corporations. I think the biggest difference is, there might be more margin expansion opportunity at FedEx just because they're starting from a lower base than UPS. But these are two what I would consider blue chip companies that are should benefit with the economy, and they should probably be able to grow top line well past global GDP, just given some of the self-help things that they have in front of them.
Our thanks to Lee Klaskow, Bloomberg Intelligence Senior Transport, Logistics, and Shipping Analyst.
We move now to big tech and Google parent Alphabet, the company reporting second quarter revenue that beat analyst expectations.
Alphabet's results were boosted by demand for cloud computing services and advertising on its search engine.
Now, despite this, investors weren't pleased that capital spending rose more than expected to support Google's AI programs and computing power needs.
For more, we were joined by Mandeep Singh, Bloomberg Intelligence Senior Tech Industry Analyst.
We first asked Mandeep for his take on Alphabet's results.
This quarter, companies are not getting a pass on boosting CapEx. That wasn't the case last quarter, but clearly I think investors are wary about how much CapEx these companies are going to throw on AI. And look, in the case of Alphabet, there is revenue in the cloud segment, so they quantified the AI impact on cloud, which was high single-digit contribution to cloud segment, and cloud segment actually saw an acceleration in top-line growth. But YouTube miss, I think I attribute that more to softer spending outside of financial services and retail, like sectors like automotive. They're not spending on digital ads right now because the sector is going through a cyclical downturn. So there is that cyclical element to YouTube's business, but I think there are a lot of positives. Core search growing at 14%. I mean, think about the scale of search and the fact that they are able to grow double digits. That's quite impressive. And that too at a very healthy margin. I mean, the biggest fear for this company was margins are going to get degraded because of AI and whatnot. That we haven't seen that. So a lot of positives, but clearly CapEx was an overhang.
All right, I've been making a point. If any team deserves benefit of the doubt of higher CapEx, it's Sundar Pichai and all the folks at Google. Stop whining about CapEx. Have they ever not generated a return on their spending?
I mean, the problem with Google's management team is they say very little on the earnings call. Like even when you answer them, like ask a question, they would answer it with as little words as possible. So, it sounded like they are bullish on their AI opportunity and it's actually monetizing. Some of that CapEx is going towards Waymo. If you think about, robo-taxis and what Tesla had to go through their call, Waymo actually did 2 million rides year to date. And these are all autonomous rides. And they're expanding to other cities. So think about, the scale in that business if they're able to do actually autonomous driving successfully. So I do think their CapEx is well spent, but they just don't explain it that well to the street, to get the credit.
So when it comes to then the AI spend, what other companies are going to get judged in the same harsh light? And what's Google's one up on them, if any?
Meta. I mean, you saw a negative reaction with Alphabet. Yeah. I mean, think about what will happen.
Meta's going to be worse.
Meta is going to be worse. Even last quarter when they raised their CapEx, Meta had a negative stock reaction simply because investors are concerned about how much this company is going to spend on metaverse versus AI. And so in the case of Meta, they're losing $18 billion a year on Reality Labs. They're spending CapEx in addition to the AI CapEx, which they launched a new large language model. And to my mind, any company right now with their own large language model, whether it's Alphabet, Meta, or a Microsoft OpenAI, they have an advantage. They have the best reasoning capability when it comes to the AI spend, and it's actually a future driver of revenue. So it all comes down to how they are going to monetize it. And I think with Microsoft and Google, they have an advantage because it shows up in the cloud revenue. In the case of Meta, they have to monetize the AI spend through ad revenue or a subscription-based chatbot offering, which nobody knows when that will come.
What is Gemini, and should I be using it?
Well, it's a better way to search for certain type of queries. So whenever you want, something with a detailed answer as opposed to going through 10 blue links to find that answer, Gemini is great. The one good thing about Gemini is when you search for a query, it's going to show you the relevant YouTube link. Whereas if you search that on ChatGPT or Claude, it's not going to have that YouTube link. So it's going to generate the text, it's going to generate a summary, it's going to answer your query, but it won't have that appropriate YouTube link. And that's Google's biggest advantage with the large language models.
Do I have to pay for that?
Yeah, it's a $20 subscription for the advanced version.
But some people will. I think that's kind of...
And that's where, I mean, you don't think it's a big deal, but I think Google owning Maps and YouTube is such a big deal in this arena of large language models because it's one thing to generate a text-based response. It's another thing to have a blue link with the YouTube video that they want you to see or the map link that they want you to click on inside that response. And other large language models can't do it because they don't own these assets. So,
well, before I let you go, if these companies though don't spend, then at some point when all this is monetizable in a big way, all of a sudden everyone's going to complain that then Meta's super far behind. So what's the chicken and the egg here?
I mean, I still think nobody wants to be the first one to pull back on CapEx. So it really is a question of when do we have sufficient supply of GPUs And because the market is supply constrained when it comes to the chip side of the equation, nobody wants to come across and say, oh, I have enough and I don't need to spend on CapEx anymore. And I think right now these companies generate so much cash every year. Like Alphabet will generate over 100 billion in free cash flow. So they can afford to spend 60 billion in CapEx. And they're looking to make a $23 billion acquisition that fell through. But clearly, they want to spend their free cash flow.
Our thanks to Mandeep Singh, Bloomberg Intelligence Senior Tech Industry Analyst.
Coming up on the program, a look at why the audio streaming giant Spotify reported record profit last quarter.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Alex Steele, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We move next to corporate earnings from Comcast and Spotify. This week, Comcast reported second quarter revenue that missed analysts' expectations. The global media and tech company was dragged down by a slower season at its movie studio and theme parks.
On the other hand, Spotify reported a record profit in the second quarter and strong growth in paying subscribers. This comes as Spotify has significantly trimmed costs over the last year to boost profitability.
For more, we were joined by Geetha Ranganathan, Bloomberg Intelligence Analyst on U.S. media.
We first asked Geetha for her takeaways from Spotify's results.
Really, the number here for Spotify and the main story has not just been great subscriber growth. So they've been adding a solid 5, 6, 7 million premium subscribers every quarter. But for them, what it really has been over the past few quarters has been this inflection in profitability. Remember, what we're now looking for streamers across the board, and this goes to Netflix and everybody else in video streaming, as well as Spotify, which is the main audio streamer with a 35% market share. The narrative has really shifted now to profitability, and they absolutely blew it out of the park. So the gross margin guidance that they had given was 28%. They came in at 29%, but even better was the outlook. So for the longest time, Spotify was stuck at like a 25% gross margin. They were pointing to like longer term margins of 30%, but looks like they're going to be able to hit it right in the third quarter.
So did it take anyone else's lunch, or this was just a really good sort of management cost issue?
Yeah, it's excellent management. More importantly, it's also price increases. They hadn't taken any price increase, Alex, for more than 10 years. And then in a span of 2 years, they've raised prices by 20%. And that's just because they know that people love Spotify. Nobody's going to churn from Spotify to, let's say, Apple Music or YouTube Music. They have a 36, 37% share of the global audio market. And they're just adding so many features and so many new verticals that they're able to take those price increases. But of course, apart from that, it's also been a very good story when it comes to cost cuts. So they were investing heavily in their podcasting business, like with the Joe Rogan show and adding all these other exclusive podcasts. They're being much more prudent now on that front. And those cost cuts, again, have really driven profitability.
How much of their revenue is subscription versus advertising versus other these days?
Almost all of their revenue, Paul, is subscription.
Ooh,
so
it's
a very, very heavy subscription-based business. They are trying to build the advertising business, but as you know, again, that takes time. That will drive the longer-term margin story, but as of right now, the mix shift is really subscriptions.
That's pretty impressive. Hey, can I ask you about Comcast and what you made of their earnings that came out earlier, reported second quarter revenue that missed analyst estimates? It was the movie season, you got theme parks, the whole thing.
Yeah, so Comcast is an interesting story. So Comcast is actually, your typical media conglomerate. They own both video distribution, broadband connectivity, as well as the media side of the business with NBC. 80% of their EBITDA actually is related to just broadband subscriptions. And so what happened this quarter, we were expecting a little bit of softness in broadband. And as expected, yes, they did lose subscribers. Remember, the whole cable industry is really in a slump because of very, very intense competition from some of the telecom offerings, both with fiber and fixed wireless access. So we're kind of seeing that slump, and it looks like Comcast is really not going to be able to get out of that slump. More interestingly, however, for both Comcast as well as Disney, is that the theme park attendance is actually flailing. And a 24% decline in their theme park EBITDA. Yeah, and that's really because huge pull forward, or what they're saying was a huge pull forward post-COVID, and now we're kind of seeing normalization. So that was a little bit of a disappointment. But I think overall the business is fine, but we are going to see some extended softness over the next few quarters.
And when you look at Comcast, great collection of assets, but they're all facing serious headwinds. What's the feeling among analysts and investors you talk to? Like, what can a Comcast actually do to become, an attractive stock?
So Comcast, of course, Paul, as you well know, it's always kind of been saddled by this conglomerate discount. The big question, and we know Brian Roberts has always been hungry for some kind of deals. So they're obviously a wild card when it comes to M&A. I guess if the administration changes and if it's more favorable for deals, I think Comcast will be a major player. We don't know whether they'll look to do some kind of joint venture with, Warner Brothers or Fox. It remains to be seen, but of course they will be a major player in the space. Again, in terms of what would move their stock, maybe if they spin off their NBC business. Brian Roberts has not indicated any such thing, but I think over the near term, what really needs to happen to kind of move the sentiment on the stock is they have to show positive broadband subscriber growth.
All right, thanks to Geetha Ranganathan, Bloomberg Intelligence Analyst on U.S. Media.
We move next to earnings from the pharmaceutical company Astrazeneca. The company raised its profit and sales forecast for the year.
The results were boosted by demand for blockbuster cancer drugs. And for more, we are joined by AstraZeneca Chief Financial Officer Aradhana Sarin.
We first asked her for her take on this week's earnings.
All the upgrade is being driven by product revenue. This quarter was actually a record quarter, $12.9 billion in revenue. And it was driven across the board with record revenues in all our therapeutic areas. So oncology, which is about 41% of our business, $5.3 billion in revenue, growing 19%. Cardiovascular medicines are growing 22%. Respiratory and immunology growing 26%, and our rare disease business, which is about a $2.1 billion business, growing 14%. And same geographically, we're seeing very strong growth in the U.S., double-digit growth, also in emerging markets and in China, both growing around 18%, Europe 24%. So it's really demand for all our innovative medicines across different geographies and across different therapeutic areas. So we raised our guidance for the year, both on revenue and EPS, to now mid-teens. And it's almost, in some ways, you could consider a double raise, because we also said that we would meet these guidance without any increase in collaboration revenue that we were anticipating earlier in the year. So it's really driven by fundamental underlying growth.
So, Doctor, I know I'm just looking at the Bloomberg terminal here. I see you have a run rate revenue of about $50 billion right now, and you guys have said that you're targeting $80 billion in sales in 2030. What's going to bridge the gap? What's going to get you there? What should we be keeping an eye on?
There's a lot going on in the pipeline. What's the ambition that we set for 2030 of 80 billion is driven by, I would say, three different elements. The first element is the products that we have today and the indications we have today and growth in those, and that's sort of what you see in the quarterly performance. The second element is the current products that are on the market, but what we call life cycle extension. So entering into, for example, additional indications or expanding indications in other tumor types, et cetera. That's a second element. And then the third element is new molecular entities. So these are brand new molecules which we've discovered, we're working on, that are in phase 2 or phase 3 clinical studies, and hope that we'll be successful in them and we'll launch them by 2030. We have set an ambition of achieving this revenue, but also launching 20 new molecular entities by 2030. Having 25 blockbusters, so that's products over $1 billion in revenues in the year by 2030. And what's going to bridge the gap? If you look at the studies we have ongoing, we will have probably about 40 studies in the next 18 months. So by end of 2025 that we hope to read out. And that will give us more confidence with the trajectory that we're on achieving that 2030 ambition. So This is it's a risk business. Obviously, we take risk every day. We invest 22% of our R&D, of our revenue in R&D. So it's a very R&D heavy business. And, we hope that, our studies are successful to achieve those goals.
Are governments your friend or foe right now in terms of the UK being an unfavorable or favorable environment? There's also the threats of IRA potentially being rolled back under President Trump. How do you guys sort of think about government interaction with your company?
Governments are a very important stakeholder for us. In the U.S. As well as outside the U.S., many systems, healthcare systems, are single-payer systems. So we do work very closely with governments. The most important thing for us is, once we've spent the money and developed innovative medicines, whether it's for cardiovascular disease or oncology, that patients actually get access to those medicines, and we can make an impact in their lives and, from diseases they're suffering from. And in that way, we need to be able to demonstrate that these drugs have value and are bringing value to the patients and to the healthcare system. And we work very closely with governments and with systems to make sure we get access to those medicines.
Dr. Sarin, I always joke on the show that when I come back in the next life, I want to be a healthcare M&A banker, because it seems every Monday we come in and there's another deal out there. How do you and your company think about M&A to kind of drive top line growth versus the R&D that you've already talked about?
So the ambition that we set for 2030, the 80 billion, does not include any major M&A. We are always looking from a scientific standpoint, not only within our own labs and identifying, what could be the next most promising molecule, but also looking outside and science that is happening in universities and biotech companies and so forth. Over the last year and a half, we've invested close to 7 billion in doing licensing transactions and partnerships and smaller M&A transactions that help to build our pipeline and really fit very well strategically with us in terms of the ambition that we have, and particularly in new therapy areas where we've made some investment, but it can help us leapfrog into the field, for example, in the case of cell therapies or in the case of radiopharmaceuticals, and accelerate the investments that we're already making. So, we're always looking for those types of partnerships.
So this is a really un-CFO-y question to ask you. What's the coolest drug that you guys are working on right now? The one thing that you're most excited about and a potential breakthrough there?
I don't know if it's an uncool or maybe it's unfair. It's hard to pick from your children, right? So there are just so many exciting things happening. Every few weeks we get some new data that makes us excited. So it's really hard to pick a favorite child. But there's a lot going on, and we live in very exciting times where not only is what we do in Astrazeneca is important, but science is evolving so quickly, and technology is evolving quickly, and we're sort of at the forefront of that innovation.
Our thanks to Astrazeneca Chief Financial Officer Aradhana Sarin.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern, on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.